Hello, and welcome to Virtual Investor Conferences. My name is Matt Lateplo, and on behalf of OTC Markets, we're very pleased you have joined us for our next live presentation from Lindian Resources Limited. Please note you can submit questions for the presenter in the box to the left of the slides. You can also view a company's availability for one-on-one meetings through the Schedule Meetings tab found on the conference platform. At this point, I am very pleased to welcome Trevor Matthews, Executive Director of Lindian Resources Limited, which trades on the OTCQB venture market under the symbol LINIF and on the ASX under the symbol LIN. Welcome, Trevor.
Thank you, and great to be here today, and good morning to everyone that's viewing this presentation. So just to sort of give a high-level start, as mentioned, Lindian trades on the ASX and the OTCQB. We're a resource company. We have a number of projects in Guinea, bauxite projects, but the main focus of today's presentation will be on our major rare earths project in Malawi, Africa. So just moving through the presentation. So this is a bit of corporate information just to kick off with. The company's got a market capitalisation of about $80 million US, 133 million Australian. Has about $13 million in cash at the moment, so we're reasonably well cashed up. We're in a stage, we've just published a feasibility study, and I'll talk about the results of that. And we're now into the funding phase and looking to start construction later this year, be in production or at least commissioning and ramp up by the end of 2025, early 2026. So be into full-scale production during 2026. So as I mentioned, we have projects in major bauxite projects in Guinea, in West Africa here. We have some assets in Tanzania. We won't really talk about them. They're relatively minor. And of course, our Malawi asset, which is the rare earths project, Kangankundi. Our head office is in Perth. And we're a pretty active company and have a very strong board as well. So just moving into the Kangankundi rare earths project. Malawi's a stable jurisdiction. It's had democratic elections and hasn't really had any social unrest to speak of. The project that we're talking about, Kangankundi, is in the south of Malawi. Malawi's landlocked. You can see Mozambique on the right-hand side there, or on the east coast, and then further north is Tanzania, and you also have Zambia and other countries surrounding the border there. There's a large lake system there called Lake Malawi. Lilongwe is the capital, and the project's located near the second largest centre of Blantyre. You can see it's quite well set up with rail and road. That's a rail network going to a port, Nacala, which we use for exporting. So we've got all our licenses and permits in place to develop this project. As I mentioned, we've completed a feasibility study, and as part of that, we had our maiden ore reserve. These are bankable tonnes, I guess I'd describe them as. So they're a pretty important outcome as part of the feasibility study, which had very strong economics. So just moving on from there. Just in summary, this is the feasibility study results. We're in a market which is low priced at the moment, but has a very strong outlook. The demand for permanent magnets, for electric vehicles, and also for wind turbine or energy generation. These sort of high rotating devices are the demand for NdPr, which are two of the rare earth elements. They're the main ones that we produce, and they're sort of abbreviated term for neodymium and praseodymium as well. So just truncated to NdPr. We have about annual production of just over 15,000 tonnes of concentrate. The feasibility study, based on the ore reserves we put together, had a 45-year life of mine. the actual amount of resources in this project. So you've got as I said, ore reserves are a subset of resources. They're based around the economics of the study, but our current resource base is over 250 million tonnes. The ore reserves are about 23 million tonnes at the moment, but that's still enough for 45 years of production at the planned production rate. From FID, so once we get financing in place, it's about 15 months to first product. You can see some of the economics of the project along the bottom there of that slide. So, we're doing this project in 2 stages. Stage 1, and that's how we can basically work on a fairly low capex. In fact, this is easily the lowest capex development cost of all of our peer companies in the rare earths sector. Most other companies are looking at development costs in the hundreds of millions of dollars for their project development. In our case, our project, though, economics, because of a lot of the grade of the ore body that we're dealing with and a lot of the other elements around the project development, I'll run through some of the key features of the project, which give us a low capex and also a low operating cost. But pre-tax NPV for a small stage 1 project of nearly $800 million is significant and a really major outcome from the feasibility study. Pre-tax IRR of 99%. Mentioned the capex and a very low. We're in the lowest cost quartile, which is a pretty significant achievement for what is a small scale startup project. The resource and reserve base, I've mentioned those, so 23 million tonnes at 2.9% total rare earth oxides in the ore body. So, that equates to around 800,000 tonnes of rare earth oxides in the ore reserve. But mineral resource is a lot larger, 261 million tonnes. So you can see this project is got significant expansion potential and a long life. Very low radionuclides, so thorium and uranium can be problematic for some rare earth projects. But in our case, we're actually very, very low and have already been identified, or our product's been rated as just being suitable for general transport. So we don't have any transportation issues and we don't have any waste storage issues as well. Some metrics down that table, but basically probably the important ones there are, I've mentioned concentrate production. Our concentrate grade is 55% TREO, or total rare earth oxides. What that translates into is approximately 8,000 tonnes of total rare earth oxide production. Within that 8,000 tonnes, approximately 20% of it is NdPr, which are the rare earth elements that are used predominantly in permanent magnet production. NdPr makes up about 95 to 98% of the materials required for permanent magnet production. So, it's in high demand and forecast to grow significantly in terms of demand. Our mine, one of the key features of the mine is that we have no overburden. So we have a strip ratio, which is a cost driver. In our case, it's a very low strip ratio of just 0.2 to 1. So that helps lower your costs. Very conventional mine, drill and blast, load and haul. You can see that we're actually mining into a hill and a sort of a farming area in Malawi. Malawi is quite a low socioeconomic area that we're located in, within Malawi. About 80% of the population in Malawi live on or below the poverty line. So projects like this can create a lot of benefits in terms of employment, more money in the local economies, and obviously in taxes and royalties for the country economy. So projects like Kangankundi can make a material difference. And we have a strong focus also on our ESG elements of our business. So creating jobs, social investment, mining in an appropriate way, and also managing, storage of waste materials, etc., all parts of our plan. Just moving on. It's a picture of the processing plant here. So the mine itself would be up on the upper right-hand side. You can just see the slope going up the hill there. So what we have is the ore is hauled down the hill, which is also another cost benefit, with trucks coming down loaded and going uphill empty, so lowers your fuel consumption and wear and tear on the vehicles. We have a ROM pad, which is basically the ore stockpile that is crushed and screened into a coarse ore stockpile, fed into grinding mills here, which again grind the rock into very fine particle size. It's then classified. The oversized goes back through the grinding circuit. The undersized material goes into the gravity separation circuit, which is basically like an inverted spiral that we use. We're using MGSs, which are a newish sort of technology in this area. And then we use magnetic separation for further concentration of the product and removal of impurities. And there you see the thickener tank, which is where the tailings goes, because we're only recovering 3% of the rare earths, or attempting to recover that. So a lot of the material then makes its way out into the tailings dam. But I think one of the key things I'd say here is that in all of this processing, we don't use any acids. We use virtually no reagents. So we actually have a very clean waste stream because of the fact that we have basically no chemicals coming out of the system. So, no reagents and acids. They're quite often used, or nearly always used, in other processing routes that other mines will have. So this is quite unique and results in, again, low costs, but also, as I mentioned, a clean product that when it goes to tailings, which is where you store your waste material, you separate and harvest the water. The water doesn't have any chemicals in it, so we don't need to treat it. We can just bring it back and reintroduce it to the processing circuit. So it's part of our water harvesting and conservation sort of aspects of the project. So, another good positive element of the project. Another cost benefit here when we look at infrastructure and workforce, for a country that doesn't have a very strong industrial base, we're really well endowed with infrastructure. We have main highways surrounding the project, and we have grid power network connections or transmission lines, some within only 5 kilometres of the project. So consequently, we can get grid power. It's mainly hydropower, so quite green or low carbon. And we do have backup on-site diesel power generation just in case, but our understanding of the network reliability is that it's very high, and we don't anticipate that we're going to have to use that at all or very often. So grid power is probably about a third of the price of diesel-generated power, so major cost benefit there. And a lot of mines really rely on diesel genset or other forms of hydrocarbon sort of energy generation because of their locations. You can't pick where a mine's going to be, so quite often it doesn't have the energy infrastructure. Water supply is able to be sourced from the mine permit locations, which again we don't have to pipe over any distances to get water supply to feed into the plant and for other uses on the mine site. I've mentioned about the tailings storage facility. It's part of the infrastructure that we're developing on site. And there's other facilities for fuel storage, admin, warehouses and maintenance. Approximately 200 people during construction on site, and then longer term, another 110 full-time equivalent during operations. This is stage 1. We have a stage 2 expansion we're starting to just get our heads around, but you would see a significant lift in the number of employees. These are employees directly employed in the operation. You generate a lot of other employment in small business opportunities and just higher salaries and wages coming into the community, which starts to generate more benefits for the local economy. From there, I've mentioned about the excellent infrastructure. So you can see that, and I've mentioned about that rail link to the Nacala port in Mozambique. So our product's got a fantastic setup really for a mining operation to be able to just do a little bit of road transport. The products are transported 1-ton bulk bags, and those bulk bags are put into 20-foot or 40-foot containers, transported initially just bags on the back of a truck down to Blantyre here, or a place called Lindian, which is in the Blantyre area, and then it's loaded onto the rail network and then transported in containers and transported in those containers to the Nacala port and then exported to overseas customers. So just a little bit of high-level information on the capital cost here. We've got contracts we've gone out to bid on, so our capital costs are pretty well defined. Our operating costs are all based on quotes and bids from either the logistics tenderer. We've got a mining contractor to do the mining. We have power rates given to us by Eskom, the energy supply company in Malawi. So, and we've gone out and gotten quotes for other consumables. And of course, our labour costs are based on labour market research. So, our operating and CapEx costs are very well defined. Even saying that though, with the capital costs, we have about a 12.5% contingency allowance within that $40 million that I mentioned earlier on. Ultra low, as I mentioned, we're in the lowest quartile of the overall rare earth producers' cost curves. And $2.92, that's an FOB, so that's basically, takes into account the product logistics to get it to the port, all in sustaining costs. So when you talk about being delivered to the end user, so you've got ocean freight in there, and royalties and other costs attached to that, including taxes and that, to get to $3.71. But this is still, one of the lowest cost mines in the world. Certainly in the Western world, it would be the lowest cost. And this is a cost curve that's been prepared for us by a group called Project Blue. Project Blue is a independent market research company. So we use their price forecast for NdPr in our financial models, which give us the economics that you're seeing or will see from the feasibility study results. And here you can see that the Kangangundi project sort of sits, and this is also adding on a further processing cost to basically turn it into what's called a rare earth carbonate product. So that we're basically comparing apples with apples through this cost curve. So you can see there's only just a couple of producers, I think that is. China producers as well that sit lower than us, but we're the lowest in the world. And for a little project to be in that category, because as you expand and do much bigger developments, your unit costs will even go lower. So we think with expansion, the expansion potential for this project, we could become the lowest cost producer in the world, which makes the importance of all this is when you're in the financing phase, and I think for investors too, just more broadly, prices do go up and down. We're at a low point in the cycle right now, but even at current spot prices, our project makes money, even it's on this small development that we're doing. What's driving rare earth demand? I've mentioned about probably the two key drivers are electric mobility and also the wind turbine energy, but other high rotating parts such as high speed trains and other sort of vehicles. You can see a couple of graphics there of the different end users, and what's driving it is obviously climate change and technology breakthroughs, et cetera, et cetera. So NdPr market itself is predicted to triple in the period to 2050. So you need 3 times as much supply as just recently in 2023. So these again are forecast by Project Blue in terms of where the expected growth is going to come from, even if you just continue the previous trends. So we see the forecast is to be much higher levels of growth, in fact 13.6% compound average growth. Even if you follow the trend line, it's just under 10 at 9%. So it's pretty significant. It's about a 50,000 tonne a year market at the moment. As I mentioned, we're bringing on about 1,600 tonnes, so we're not dramatically changing the supply side. But at these sort of growth rates, if you're between 10 and 14, even in the near term, you're going to need another 5,000, 6,000 tonnes of NdPr next year, this year, and then next year, and continue on. So, but our project isn't going to change prices or affect. It's just going to be filling a little bit of that increasing demand at this stage, and as we expand, we can become a much, much bigger part of the global supply chain, and we'll be feeding an expanded sort of material into a much larger market if we look at where, demand is growing. Price forecasts, we've used the blue line, which is the Project Blue real price forecast. You can see there's a whole bunch of other forecasts from different groups. So we think we're pretty conservative relative to what the consensus sort of forecast would say, which is probably where the average is. So, we've been conservative, but even with those prices, so $70 a kilo in year 1, so that's year 1 production, which is still a couple of years away. Year 1 to 5, average is 82, and life of mine's 109. As I mentioned, current spot, or I might not have mentioned, but current spot's about 50. So, and this is pretty much at the low point of the cycle, we feel. Marketing strategy, we're diversifying our markets, and it's pretty difficult to avoid selling material into China. That's just a part of the market, but we are looking to also distribute the product through North America and Europe. There are some customers there, even in Central Asia. There's some processors that would buy concentrate material. And because we're producing a reasonably high-grade concentrate at 55% TREO, we can sort of look towards a bit of a premium relative to current market outcomes. So operating financial metrics, I've mentioned a little bit about some of these, the pre-tax and IRR number, pre-tax NPV, cash payback periods 1.25 years pre-tax, and an NPV to CapEx. So this is the multiple from your CapEx development to NPV of 19 times on a pre-tax basis, which is virtually unheard of. So, this project is very, very robust. You can see some of the average annual EBITDA. So even in the first lower price period, over the first 1 to 5 years, it's around 54 million a year, 84 over the life of mine in terms of US dollars. So, this is a very strong project. As I said, expansion, we'll be planning expansions in the future, so these numbers will be significantly higher. Spot price, I've mentioned we're profitable at that. So even at current $50 a kilo price, we make an EBITDA of about 11 million. As I mentioned, we think this is the low price point of the cycle. 57 million EBITDA on year 1 to 5 on average, which is referred to here, and life of mine 83. So very strong project. Typical sensitivities, and as you see, NPVs are generally very sensitive to things. For mining projects, it's commodity price, whatever discount rate you're going to assume in the model. recoveries, because that's a bit of a revenue driver as well. It's how much product you make from your processed material, and also mine grade. So we can see potential use of funds in terms of the next 18 months is outlined here. The indicative development timeline. So as you see here, we're right at this sort of Q3 point in 2024. So we've just finished the feasibility study. We're still involved in engineering design in relation to the project development. We're looking by the end of this quarter to have at least confirmation of our funding. And then from there, we'll move through the typical sort of contract awards and various stages of the earthworks and processed plant construction. So by Q4, the end of Q4 2025, we're going to be in the commissioning and ramp-up phase, and then by Q1 2026 into first product on ship. Mentioned about ESG and a little bit conscious of time, but we do take this very seriously. And you've got to be, when you're working in, in African countries and in communities that have, like, as I mentioned, very low socioeconomic outcomes, your obligation to create jobs, to invest in the local communities and provide, long-term opportunities for the people in the region is pretty important. In addition to that, your governance systems have got to be pretty good operating in some of these jurisdictions, and you've got to have a strong focus on people welfare and other elements. And of course, you've got to manage your operations in a responsible way from the point of view of your environmental management as well. We've already done a lot of work in the community. We've just recently actually completed our resettlement program, where we had to purchase the properties that the subsistence farmers in the region were farming to be able to develop the mine and the infrastructure on the mining licenses. So that went well, and we had a lot of cooperation in that process. So those relocation programs are all but complete, and as I mentioned, we're now ready to move towards development. We've completed our some local investments, and we obviously bring a lot of economic sort of benefits in taxes, royalties, jobs, training, and small business. Got all our environmental approvals and licenses in place. And as I mentioned, we've been through the feasibility study results as well. So I won't cover much on the bauxite project. The intent today was really to talk about the rare earths projects. And so, Lindian, I think, represents a fantastic investment opportunity. We're very low market cap. If you look about other companies, our project's actually larger than, say, LINIF, which is another ASX company with rare earths production, does do downstream processing, so we're not like for like, but we think we can be matching up with Linus in the future, particularly with our stage 2 expansion. Such, when you consider that that company has a market cap of about $6 billion, and we're about 130. This is in A dollars. We think the upside or the potential for the company is significant. So with that, I'll just end the talk and actually have a look at just move into the Q&A. I think I've got a couple of minutes. Time frame for production is one question that's been raised. So I've actually mentioned that. We just covered that schedule. So basically by, commissioning the end of 2025 and be in production and ramping up during 2026. The number to reach production, there was a slide, that's another question. So how much money is required to get to production? There's a slide earlier on which showed a requirement of about between 80 and 90 million dollars Australian to get to production. So over the next 18 months, we require that. We obviously don't need it all at the start. we can fund that. We're looking to fund, a fair amount of our capital expenditure and other requirements through debt. And then, we'll have to, we'll do some equity funding as we move through the process, but, we're expecting our share price to increase quite significantly. Sorry, just having a few glitches there. I think I'm just about at the end of my time. Offtake, somebody's asked the offtake agreements with Gerald. They're actually market-based pricing. So I guess if you want to call that, it'll be at the market pricing at the time. So effectively spot. And any geopolitical risks is another question. Any geopolitical risk with your Guinea and Malawi projects? Probably focusing on Malawi. Sorry. As I mentioned, it's been a very stable country, follows British law, and basically the systems and processes that we're operating with. By that I mean the laws and the regulations that apply to mine developments are pretty clearly outlined. So we don't see that we've got any risks on that front. The country's keen to develop its three industries: mining, tourism, and agriculture, to improve its economic outcomes for its people. So, we're a key part of that, and we're getting a lot of support from the government as we move forward. So I think from a geopolitical sort of perspective, we see that, we're at, I think, a pretty good level of risk as far as an African country development goes. So with that, I'd like to thank you all for your attention, and